Hannon Armstrong, or HASI for short, is a company that I can't help but get excited to talk about. HASI has almost doubled the performance of the S&P 500 over the most recent 5-year span. But what really has me amped is that this company's business model is pretty much a perfect mirror of this channel's. You see, HASI's business is investing in climate change, and that's exactly what we do here on Renewable Energy Investments. In fact, HASI is the first public company in the US to solely make climate-positive investments, and it's been doing so for almost 40 years. Laser focused on solving the carbon emissions problem, every single investment that HASI makes must lower or mitigate climate change. In this video, we're going to discuss what HASI's business is all about, and then I'll explain why I'm thinking I'd like to add this stock to my Roth IRA. But before we do, hit that thumbs up button to help support this channel and all the research work that I put in. HASI's business. As explained by HASI's CEO on a recent earnings call, HASI should be viewed as a company that invests in the future of energy, which is decentralized, digitalized, and decarbonized. Currently, HASI has a more than $2 billion investment portfolio, which HASI categorizes into 3 main investment classes. First is HASI's behind-the-meter technology. Essentially, HASI makes investments to improve government and corporate buildings by adding energy storage, installing small-scale on-site power generation, or improving the building's heating or lighting systems. The ongoing energy savings realized by these buildings are used to pay HASI recurring cash flows. The second is grid-connected power. This is where HASI invests in solar, wind, and energy storage projects that sell power to utility and corporate buyers through the mainstream power grid. HASI's third line of business is investing in sustainable infrastructure. Essentially, HASI looks to finance infrastructure assets like stormwater remediation or environmental restoration. And HASI foresees potential for significant growth here as communities adapt to increasingly severe weather events. What I love about HASI's investing strategy is that virtually all of HASI's investments save the obligor money even after factoring in the payments made to HASI. HASI's projects are win-win for everybody involved. Couple this with the fact that HASI's investments are contracted with large, creditworthy, and responsible leading companies, including Amazon, Microsoft, and Target, and one can start to get very comfortable that HASI has built a relatively low-risk investment portfolio. Another great aspect of HASI's investing strategy is that HASI uses a diverse array of investment vehicles, adding additional diversity to its revenue streams. For instance, sometimes HASI takes an equity stake in its projects. Other times, HASI is awarded government and commercial receivables or securities. Sometimes, HASI purchases the real estate on which its projects sit. HASI even generates ongoing fees by providing services and asset management. This wide array of investment structures allows HASI to capitalize on a variety of low-risk opportunities as they may arise. For instance, its preferred stakes in wind farms generate higher returns than the debt while experiencing less volatility than an equity stake. Buying land under solar projects allows HASI to generate a relatively low risk of return on its assets. Either way, the goal of HASI's investments are to generate long-term recurring and predictable cash flows with low risk. HASI's impressive growth. Coinciding with HASI stock's impressive market outperformance are very strong top and bottom line growth figures. For instance, total revenue grew from $59 million in 2015 to $142 million in 2019. That's a 24.5% compounded annual growth rate. And HASI's core net investment income has kept pace, with a 23% compounded annual growth rate to $82 million for 2019. What makes this growth rate all the more impressive is that all throughout its expansion, HASI has significantly deleveraged, from a debt-to-equity ratio of 2.1 in 2015 to 1.39 as of Q1 2020. And this deleveraging was not merely a result of new equity issuance, as the company has maintained its core return on equity of around 10% for the last 5 years. As clean energy finance picks up steam over the upcoming decade, it should become even easier for HASI to fund its future growth. HASI's REIT status. HASI maintains its real estate investment trust status based on its investments in buildings and strategy of investing in the ownership of land surrounding various power projects, rather than the projects themselves. And because of its unique REIT status, HASI stands out from other renewable energy investments. REITs are generally exempt from taxation at the corporate level so long as they distribute 90% of their income to unit holders. So not only does HASI avoid significant corporate level taxation, but it also requires HASI to stay focused on making distributions to shareholders. Both significant positives, in my opinion. My opinion. Flat out, I would love to add some HASI to my portfolio. HASI is not the sexiest stock, but that's okay. HASI will not be pioneering new game-changing technologies. HASI will not be releasing new products with the potential to disrupt an entire industry. But HASI's business model has proven to be resilient, even during the Rona. And a stable, resilient company may be a very nice complement to my portfolio that features many high-growth, high-tech innovators such as Tesla. Because virtually all of HASI's investments save the obligor money, and its clients are large established companies, HASI's revenues are very stable, and HASI should continue to grow its earnings regardless of any hard times. HASI is set up to achieve solid returns, and if the dividends are reinvested, the returns should compound over time and have sort of a snowballing effect. If HASI can come anywhere near duplicating its 25% annual return in the future, I would be thrilled. I really like how HASI differentiates itself by being structured as a real estate investment trust. I'm thinking I might use my Roth IRA to do some of my buying so I can avoid the ordinary income tax rate that REIT dividends are subject to, while still benefiting from HASI being able to avoid paying income taxes at the corporate level. If HASI doesn't pay taxes at the corporate level, and I don't pay any taxes at my Roth IRA, little to none of the earnings would be subject to any tax leakage. I also like that HASI should provide substantial diversification to my portfolio, given the wide array of investments that HASI is involved in. Ultimately, as the trend towards renewable energy generation plays out over the next couple of decades, there will be no shortage of projects for HASI to invest in. I see no reason to suspect HASI's pace of growth would slow anytime soon. But honestly, the valuation is a bit rich at the moment, as HASI is currently trading at an all-time high. I'm probably going to add this one to my watch list and hope for a pullback opportunity to scoop up a few shares. Quick shout out to all of you guys who have suggested stock ideas like this HASI video. I really like seeing what stocks you all are interested in, and sharing your ideas is very helpful to the channel. Keep them coming. And make sure to subscribe and click on our videos when they are shown on your YouTube homepage so you can follow along. See you guys on the next one.